Good day, guys. How are we all doing? Are we all good? So today we're just going to quickly go through SMT divergence, what it is, and I'm going to show you a quick trade which I took today during New York session. So what is SMT divergence? SMT simply stands for Smart Money Tool, a concept which is used to identify price divergences between related markets, indices, or currency pairs. It shows where liquidity is being manipulated, helping you as a trader to anticipate a market direction. So before I proceed, special shout out to this guy. I actually took his screenshots from IG and I thought they would actually be the best illustrations to use explaining this trade since the setup actually appeared this afternoon. So special shout out to this trader. I'm not sure how to pronounce his name, but yeah, special shout out to him for doing these illustrations and posting them on his socials. I just took like screenshots. So here is an example of an SMT whereby price creates the first leg, second leg. So here you can see we've got like a liquidity sweep. And please take note, this is an ICT concept. All right, it's an ICT concept. So one asset will create like a lower low with a liquidity sweep in a buy example, and the other asset will fail to create a lower low and will actually create a higher low. All right. Why we use SMT divergence. SMT allows you to identify relatively weaker or stronger pairs. If you are shorting, you want to trade the relatively weaker pair. And if you are going long, you want to trade the relatively stronger pair. By doing so, you tilt the probabilities even more in your favor. So again, it's just the same example. This is simply an illustration of how the weaker pair is going to look like. So the weaker pair is usually the one which is going to give you the liquidity sweep, and the stronger pair is the one which is going to give you like the higher low if you are in a buy motion. Where do you use this SMT? So SMT works best when price is reacting for a higher time frame zone. So this is one of the key factors you want to actually incorporate in your trading. The SMT only works best when the price is reacting from a higher time frame zone. So for example, if a higher time frame zone, e.g. on the 4 hour, if you have got an order block is respected on Euro USD, SMT can help confirm the manipulation by comparing its movement to the GBP USD or to the DXY, which is also the dollar index. So we managed to get another good illustration. Shout out to this trader. On the 4 hour order block, you can see price created this lower low, then created a higher low, break of market structure. So it's basically like an ICT setup. A bullish SMT divergence occurs when one market makes a lower low, grabbing liquidity, as you see on the illustration below, and another related market makes a higher low, showing relative strength. This signals potential smart money accumulation and is a bullish reversal. Bearish SMT. A bearish SMT divergence occurs when one market makes a higher high, grabbing liquidity, and another related market makes a lower high, showing relative weakness. So from what this trader is telling us, the asset which is weak is the one which fails to create a higher high, thereby completing that SMT divergence which you see here. This is exactly the setup which we had today on NAS 100 and US 500. I'll show you an example just now. So this signals potential smart money distribution and a bearish reversal. So if you're using SMT, the SMT pairs you can look at, you only need to look at GU and Euro USD. So if you're trading currencies, if you're trading GU by any chance, or if you're trading EU by any chance, you simply have to have the two of them side by side, and you can add the dollar index just for confluence. Then if you're trading indices, then you can pay attention to NASDAQ and the S&P 500. And sometimes you might throw in US 30, but these two work just fine. So shout out to this trader for giving us these perfects. illustrations. I'm not sure if he's got a YouTube. You guys should actually go and follow him. I believe his content is actually also on point. So just going into the charts. So on our charts, you see to our left, we've got the ES or the US 500 or the S&P 500. On our right, we've got US Tech or NASDAQ or US 100. So this is the 4-hour time frame. And you see, okay, made a mistake there. Just wanted to highlight for you. Right. So you see to our left, ES was reacting off this zone from last week. Right. Last week we had this gap. It's also a zone in its own respect, and price came and tapped into that area. So we've got a higher time frame confluence. To our right, more or less the same thing. We've got this level where price came back to retest, and it's also on a quarter point for those who follow quarter point theory or quarters theory. Price was bouncing off or finding respect of 23,500. So having confirmed that price is on a higher time frame confluence, what we do now as day traders is we now jump to M15 on both assets, where we want to locate our SMT divergence. So if you look at US 500 on our left, you can see we created this high during London session. And when New York opened during our kill zone time, so these boxes highlight my kill zone times, London session, New York session, and the PM session on the bottom here. So you can see ES was the weaker one because it failed to create a higher high and created a lower high instead. So you just mark that higher high and the lower high at the open, put your line like that. Then on your right-hand side, you see Nasdaq created the higher high. So now we've got a complete SMT divergence setup since both assets are reacting off a higher time frame zone. So now, if you don't know when exactly to enter, this is how I personally enter. I am currently using the ORB for my confirmation or the opening range candle break. So that break outside this opening range, this break is what confirms my entry and my trade basically. So let me just, excuse me, just check my phone quickly. All right. So the opening range for me is a tool I'm currently using just for confirmation of my trades. So if you are using the opening range, you simply want to highlight the first 15-minute candle high and low when the stock market opens, when the US stock market opens, first 15-minute candle. Then when you're getting that break, for me, this is what confirms that my assets are actually selling. So from what the author said, or from what the other trader said on his illustrations, you simply want to sell the weaker pair. But for me, I ended up going with US 100 because this one I saw it a bit late. I was mainly looking at NASDAQ. So I executed my trade on NASDAQ. And if you see, this trade simply played out nicely. So in terms of targets, what's your TP, stuff like that. So it depends or differs from trader to trader. You can go for a fixed risk to reward of 1:2, 1:3, depending with how you trade and where you entered. So the one I'm explaining now is basically based on my own preference. So like I said, I use ORB. So my entries are a bit late. They are somewhere in here. My entries are somewhere in here. Some traders will have their entry sniper at the top. Some will be in here. Some will be in here. It all depends with your trading style, right? So you can either use or trade the way I trade, or you can just target in terms of points or pips. So let's say you want to target like 100 points if you're trading NASDAQ or 200 points. That's all up to you in terms of your target. If you're using moving averages for exits, if you're trading towards moving averages, this is where you start to scale out on the 50 EMA. Then you also want to collapse your trade on the 200 EMA. That's if you're trading towards the EMAs and if you're using EMAs for your targets. So same applies to S&P 500 here. The 50 was very close to our entry, so you could have used the 200 EMA and the 800 for your exits. And it all depends and differs from trader to trader. And it all depends with your trading system, like what's your entry criteria and what's your exit criteria. You can also look to scale out on the opening price of the day, which is also a good place to scale out or a good place to target if you are taking any trades. So after this has been said and done, we now switch to trading view so that I can quickly show you the trades. So here you see S&P 500. These lines you see, the horizontal lines, that's my opening range candle, the breakout. I have to wait for this break to happen and close. So I literally have enough time to figure out if price is actually selling. So from the time the stock market opened to the time you would have entered, you've got about 45 minutes to decide whether you're taking that trade or not. This was on the S&P 500. Price was also trading towards the previous day's high. I failed to mention this. So if you break and come below, it also gives you that confidence that price is coming down since we are back inside yesterday's range. So if you took S&P 500, this is how your setup would have been looking like. And this is a 1:2 risk to reward trade. And if you took NASDAQ like I did, this is how your trade will be looking like. And I was basically on my side, I was just aiming for the previous day's high, which is this line you see on the bottom here. So as soon as my price got here, I had TP1 there and I had TP2 somewhere in here just before it reached 1:2. So again, opening range right here, I had 1, 2, 3, 4. I literally had 1 full hour to decide whether I want to take this trade or not. So I got my close below my opening range and I entered at the breakout of that candle with my stop loss above the candle, which broke outside the opening range and the trade simply played out. So if this is making sense to you, please throw a like, subscribe if you haven't subscribed already. Let me know if you took any trades today, this afternoon. What trade did you take? Did you find this video useful? If you did, don't forget to share with your friends as well. And if you watched until the end, thank you so much. Enjoy the rest of your day. Good trading.